Everything just changed overnight because this isn't just a military strike, it's a contradiction hiding in plain sight. The United States launches a strike on Venezuela, and somehow the oil infrastructure is left untouched. Surgical, precise, almost intentional. And if you think this is only about geopolitics or crime charges, you're already looking in the wrong direction. This hits your money, your savings, and the prices you pay every single day, whether you trade commodities or not. Here's the part that should make you pause. Venezuela isn't some marginal oil producer. It holds 303 billion barrels of proven oil reserves, more than Saudi Arabia, more than Russia, more than anyone. And yet, within hours of the strike, the focus wasn't on chaos, it was on oil flowing again. Tankers scheduled, deals hinted, infrastructure preserved. But here's the paradox. The oil that could reshape global markets is also some of the hardest, thickest, most expensive oil on the planet to extract. Heavy crude, the kind that only certain refineries can even handle. And those refineries, many of them sit right on the U.S. Gulf Coast. So ask yourself this, if this was really about punishment, why protect the pipes? And if it's about oil, what else moves when oil moves? Because the real story isn't just Venezuela, it's what this unlocks next. What we know so far is just the surface layer. A U.S. strike, Maduro captured, charges announced. But notice how carefully the story has been framed. Most headlines stop at the arrest. They talk about crime, drugs, politics. They don't linger on what stayed standing. The oil fields, the refineries, the ports, because this wasn't an accident, it was a signal. Here's the pattern forming. Venezuela used to pump around 3.5 million barrels a day. Today, it's under 1 million. Not because the oil disappeared, but because decades of mismanagement let infrastructure rot. And yet, despite that decay, the United States made sure nothing was permanently damaged. As one detail from the aftermath makes clear, there was zero damage to production facilities, refineries, or export ports. That's not how punishment usually looks. And this is where most people misread the situation. They hear 300 billion barrels and assume easy money, fast fixes, quick wins. But Venezuelan oil isn't light crude. It's heavy, thick, expensive, the kind that needs massive specialized infrastructure just to move, the kind that only certain refineries can process, which raises a quiet but critical question. If this oil is so difficult, and if rebuilding takes years and tens of billions of dollars, why move now? Because this isn't about speed, it's about positioning. And once you see who's positioned to benefit first, the rest of the story starts to line up. Here's the claim that changes how you see this. The United States didn't just intervene in Venezuela, it positioned itself to control a critical choke point in the global energy system. The proof is in the details. Venezuela holds 303 billion barrels of proven oil reserves, roughly 17% of all oil on the planet. But at the same time, production has collapsed from about 3.5 million barrels per day at its peak to less than 1 million today. That gap isn't theoretical, it's physical. Aging infrastructure, decades without maintenance, facilities more than 25 years old, and experts estimate it could cost anywhere from $58 billion to over $100 billion just to restore previous production levels. Now notice what happens next. Despite that scale, the U.S. president publicly said, "I think we can do it in less time than that. Oil companies will spend it and then they get reimbursed by us or through revenue." That's not speculation. That's an explicit statement that American oil companies may rebuild Venezuela's energy system with government backing. And here's the part people keep skipping. If this were about punishment, you'd cripple output. If it were about chaos, you'd damage ports. But instead, infrastructure is preserved, subsidies are discussed, and companies like Chevron already have 11 tankers scheduled to arrive at Venezuelan ports later this month. Notice what's missing. There's no talk of isolating Venezuelan oil from global markets. No plan to leave it underground. No suggestion that production should stay offline. The silence there tells you exactly where this is heading. Because once that oil starts moving, it doesn't just change Venezuela, it rewires who supplies energy to the United States itself. If you're thinking this is just about Venezuela's oil, think again. This entire situation isn't just about filling up tankers, it's about reshaping global supply chains. Around 70% of U.S. oil imports are heavy crude, and right now, the largest supplier of that heavy crude is Canada. But Venezuelan heavy crude is a direct substitute. Same refinery setup, Same processing requirements, same end use. If Venezuela comes back online, the U.S. can reduce Canadian dependence. Transportation distances shrink, energy costs fall, and that shift ripples outward. Fuel, manufacturing, plastics, logistics, all of it feels the pressure. Lower oil prices don't just mean cheaper gas, they mean deflation across entire sectors. And here's the uncomfortable part. The U.S. doesn't just want oil. It wants leverage. Cheap energy stabilizes inflation. Stable inflation keeps the system calm. But what happens when that pressure builds elsewhere? When you think about oil, you probably think of fuel prices, but the deeper impact shows up in money. If the U.S. stabilizes Venezuelan oil production, it gains a tool to suppress inflation, while other costs rise quietly in the background. Energy stays cheap, assets inflate, debt gets easier to manage, and while this happens, trust in the dollar system continues to erode. After U.S. assets were frozen in 2022, countries learned something fast. Anything held in dollars can be locked overnight. Since then, central banks have been buying over 1,000 tons of gold annually, double the previous decade's average. This isn't panic, it's adaptation. Oil calms the surface, gold moves underneath, silver tightens as industrial demand rises. The system keeps running, but on new rails. This is how the shift happens, quietly, methodically, without collapse. Now bring this back to your life. When energy gets cheaper, prices feel manageable, gas stabilizes, shipping costs drop, politicians declare victory, but asset prices don't stop. Stocks, real estate, commodities, they keep climbing. So even if your bills feel stable, ownership moves further out of reach. You're working, you're saving, but you're losing ground. Cheap energy acts like anesthesia. It dulls the pain while the gap widens. If you've ever felt like you're doing everything right and still falling behind, this is why. If this feels familiar, say so in the comments. Because once you see the mechanism, you start noticing it everywhere. Systems don't move on morality, they move on incentives. The United States carries roughly $38 trillion in debt. Paying it down isn't the plan. Inflating it away is. But inflation can't look obvious. Energy prices have to stay controlled. That's the lever. This is why infrastructure mattered more than arrests, why oil was protected, why rebuilding came first. Cheap energy buys time. Asset inflation shifts wealth, and the public stays calm. Meanwhile, trust quietly drains from currencies and moves into hard assets. This isn't chaos, it's design. Now look ahead. In the near term, nothing explodes. There's an initial transfer of 30 to 50 million barrels. Chevron tankers arrive. Markets take note. Then comes the waiting phase, 6 months, 12 months, infrastructure assessments, capital commitments. From there, two paths emerge, one where rebuilding drags, oil flows slowly, uncertainty supports metals, another where production ramps faster, energy costs fall, and deflation spreads. Both paths favor asset owners. Both punish hesitation. Markets move on trajectory, not confirmation, and the trajectory is already bending. Here's the final insight. This wasn't a strike to end something. It was a move to keep a system running. Cheap energy masks inflation. Asset inflation manages debt. Pressure shifts downward. Nothing breaks. It just drifts. When oil flows, prices lie. When prices lie, trust moves and wealth follows. This story doesn't end with Venezuela. It continues through energy, metals, currencies, and assets. The next move is already forming. If you want to stay ahead of it, follow, subscribe, and keep watching, because the real shifts never announce themselves.